Get out of equities, says Larry Summers. What? I actually like Larry Summers. He's a clown. He's part of the clown show. The world that it is, run by idiots at Harvard and Ivy. Disband the Ivy Leagues. You want to create equality, disband the Ivy Leagues. These people should not be running our world, but they do. It will forever be, man. Anyway, so Larry, but of all these clowns in Ivy League, Larry Summers is one I like because at least he has enough gumption to stand to stand his ground against some of this insanity of the left and the cabals that run this thing. And not all the time. He's still a creature of the swamp. Don't get me wrong, but yeah, he still has some good stuff to say on occasion. So anyway, here we are. Larry Summers, get out of U.S. equities. Be careful in the equity market, says Larry. The bond market is predicting recession, but the equity market has not priced that in. That's the issue. I don't know. I don't know that to be true. We had a 20%, 25% decline last year in the bear market. Was that pricing in the recession that has yet happened? Or did it price in a recession that did happen last year? But many people said, no, there was no recession. It was 2 consecutive quarters of negative growth. That's recessionary. They're just making this stuff on the fly. I don't know the answer to this. This is what makes it interesting. It makes me, about my own portfolio, like, I don't know. But, he's saying the equity markets hasn't priced it in. Or maybe the equity market did price it in, and again, the recession happened last year, and now it's back to going a normal thing. I don't know, man. But all I know is the 10-year Treasury is down here, and the Fed funds rate is up here. All right? That's a challenge. It's been like that for a while. Now, the Fed funds rate is at 4 3/4, I think. I just looked right now. The 10-year Treasury is at 3.5, which is up from 3.31. That's 125 basis points below the Fed funds rate. It's crazy. 125 basis points below the Fed funds rate. 125 divided by 350. That's 35%. 35%. It's insane below the Fed. The delta between the Fed funds rate and the 10-year Treasury is 35% of the entirety of the 10-year Treasury yield right now. That, I'm telling you, that has never happened like this. It's insanity. What does that mean? I don't know. Let's keep reading. The consensus economic forecast is for a recession. My man Brian Westbury, I just read about here. He says real GDP grew at 1.1% in Q1, well behind consensus at 1.9. There's a mixed bag in the first quarter. We still think we're headed for a recession. The bad news was that right here. Meanwhile, business investment in equipment, which is a harbinger of future productivity growth, declined by 7.3% in Q1, the fastest drop since COVID. Finnegan! Let's see. Meanwhile, bid declined 7.3%. Home building declined, although not as much as in recent quarters. It probably will, given the price of lumber so low. I was watching my man, the uneducated economist today. He thinks things are bad out there in terms of home building because the price of lumber is so low that people are pulling back the amount of lumber they're producing. On the inflation front, GDP rose, prices rose at 4%. All right, anyway, so the problem is which is the pace. Okay, the problem is that core GDP is up only 1.1% in the past year, which is a pace we usually only see around recessions. Yeah, 1%. New claims for jobless benefits declined. Continuing claims slipped. These figures are consistent with continued job growth, but not as fast as in recent months. All right, so we'll see. Who knows? But anyways, keep going. But Larry says earnings forecasts have not incorporated the recession yet. Yet the bond market is signaling danger. The yield curve and the Fed funds rate are predicting 6 or 7 rate cuts in the next 2 years. So again, let's talk about this. You have the Fed funds rate up here. You got the 10-year down here. All right. So this cannot happen in perpetuity. I don't think. I guess anything could happen. I think it did happen in Japan for a long time, but probably not here. All right. So what's going to happen? Either the Fed funds rate has to drop, but they're only going to drop if we're actually in an explicit recession. Even a 1.1% GDP growth rate, it's real. That's not going to get the Fed funds to, the Jerome Powell and the boys to drop the Fed funds rate. I don't think. I think it's going to be more than that. So if the Fed funds rate isn't dropping, and I think it will, because I think we are going to recession for sure. If the Fed funds rate doesn't drop, then what happens here? This has to go above that. It has to. The 10-year Treasury has to go above the Fed funds rate. It's just basic normal economics, because it can't be like this, inverted forever. It's nuts. I mean, again, anything could happen, but just come on, that's crazy. So the Fed funds rate doesn't drop, that means the 10-year Treasury will have to drop, i.e. the prices of the 10-year Treasury, for the yields to go above the Fed funds rate. And if you have a 10 duration, let's just say the intermediate bond fund is a 10 duration, that means that the 10-year Treasury drops, the price of the 10-year Treasury yield goes up 150 basis points to get above the Fed funds rate. That's going to be a 15% decline in your bonds, which is after what we had last year. It's insanity, dude. Do I expect that? No. Could it happen? Sure. I don't know. You don't know. Nobody knows. Crazy. Old MacDonald had a farm. No one knows nothing. I don't know. I don't expect that. So that's why I'm pretty big on fixed income right now and I'm fear of missing out, dude. I mean, the markets are up pretty big today. I'm hardly in that at all. But who knows, man? We'll see. All right, let's keep going. The stock and bond markets are saying different things. I completely agree with that. He said he was short the U.S. large cap equities because he obviously thinks the stock market will come down as opposed to the bond market coming down. I agree with that. The danger of the recession is driven by the Fed's policy response to rising inflation. All right, the U.S. got to this point following a period of secular stagnation. Secular stagnation. What is that? The economy was then characterized by excess of savings to investment, which kept interest rates low, slow growth, and drove down inflation. To fix that, Summers advocated for fiscal stimulus, government spending, and for programs to increase household spending. But those programs were not big enough to overcome the stagnation. This never is freaking. The problem with being a left economy, you never have to say you're sorry, ever. Those fiscal programs weren't big enough to overcome the stagnation. So what caused the stagnation? Savings glut. Too many people saving, not enough consuming. Well, let's go back to this book right here, which is ironic because there's a chapter 8, called Secular Stagnation. All right, so we're going to read this real quick. After the Federal Reserve hiked short-term rates in 2004, U.S. Treasury yields remained stubbornly low. Bernanke came up with an explanation saying excess savings in China and other emerging markets are responsible for the decline in U.S. long-term rates. So again, excess savings is leading to a cause of low interest rates, which is leading to stagnation, low growth in the economy, and whatnot. All right. Contra Bernanke, Stanford's John Taylor maintained that global savings before 2008 were actually lower than in previous decades. So the savings glut was higher in previous decades when the interest rates are higher. Interesting. So Bernanke, you know what the hell you're talking about, helicopter Ben. After the financial crisis, the world's excess savings declined and long-term interest rates declined too. See these these economists, it's like they just cherry pick. So Bernanke says, we hiked the short-term rates in the 2004, and yet the long-term rates stayed low. Why? Stagnation was here. Why? Well, because excess savings in China and other emerging markets. But Stanford's John Taylor, the Taylor rule, and off the top of my head I can't remember what that is. Pablo, stop. Said global savings were actually higher in previous past when interest rates are higher. And after the financial crisis, the world's excess savings declined. And yet interest rates collapsed. So you can't say excess savings is leading to long-term interest rates low, when in fact we had both. We had excess savings higher and interest rates are higher. But now we have excess savings lower and interest rates are lower. What? Thus, it seems reasonable to conclude that global savings does not appear to be a major factor in persistently low interest rates and slow rate of growth. So you cannot sit there as Larry Summers, I call him Larry Mooners. He says, secular stagnation. We were saving too much relative to investment, which kept rates low, slow growth, and drove down inflation. And ironically, here comes old Larry, big Larry here. A few years after launching his secular stagnation debate, Larry Summers himself had second thoughts. Gone was his former concern with demographics or the cost of capital goods. Summers, once a favorite to replace Bernanke in the chair of the Fed, now laid blame fair and square upon central bankers. He said, will they, central bankers, not consider the possibility that ultra-low nominal yields might actually reduce demand while breeding financial instability, bank failure, zombification, and reduced economic dynamism, whatever. The claim that ultra-low rates might be responsible for secular stagnation rather than the other way around was a radical thought. But Summers wasn't the first entertainment, and yet here he is talking about secular stagnation, saying ultra low interest, too much savings is leading to ultra low interest rates, which is causing economic decline. It's freaking stupid. I mean, it's such a stupid thing to say. On the other hand, it could be that ultra low interest rates are leading to too much savings. Anyway, so let's keep reading. No one knows anything. It's just we're looking at people in economics based on the Phillips curve. They love their macroeconomics because it gives them. It's like the CO2 and the temperature thing. We have this valve. If we turn the valve on for more CO2, we get increasing temperature. It's so friggin' stupid. If we turn less CO2, we get decreasing temperature. It's the exact opposite. Exact opposite. The temperatures increase and CO2 increases respectively from that. Parts per million. It's not the other way around. And the same thing here. We have too much savings. It's causing interest rates to be low. And we got to get people spending out there, dude. Spending, that's leading to secular stagnation. How about this? How about our interest rates are so low is causing secular stagnation? Because people say, I'm not getting paid enough to do anything with my money. I'm not putting it to work because the rates are so low. Or I'm going to invest in zombie companies because that's the only game in town, essentially. All right, let's keep reading what Larry says, which is exactly what's happening, dude. That's the stagnation, zombification of corporate America and Japan, China, UK, all that stuff is what's leading to secular stagnation. Because you're rewarding inefficient firms who don't know how to manage their money, don't know how to manage the resources. And you're destroying good firms who we call it crowding out when it comes to public sector borrowing when it comes to economics. I don't know if I actually believe that, but the more the government borrows, the less the private sector borrows. There's a theory behind that. It sounds okay to me, whatever. Same thing here. Zombification is crowding out of efficient businesses by taking more and more. The zombie companies require more resources. And that's what's happening when you have these ultra low interest rates. You just got to raise the rates and let the freaking chips fall where they may. Well, exactly what happened in 1920, 1921. And we had a short, painful recession, but that, got rid of these zombie companies. Got to do the same thing now. And it's going to happen, dude. Summers advocated for now that there are excess federal deficits and need to fund areas such as the green transition. Why do we need to fund the green transition if it's so profitable on its own? How much more are we going to subsidize green energy, dude? I mean, what the hell? What do you subsidize big oil too? Let's not subsidize any of it. How about that there, guy? Green energy is such a scam, which means which now we have less savings relative to investment. We will not be in a situation of massive excess savings anymore. There's more risk of rates going higher. The inflation we are seeing was caused by monetary policy. No, it wasn't. Why do these people all say that? Summers predicted higher inflation 2 years ago for those reasons. Well, that was easy to predict 2 years ago. We could see supply chains. We could see the price of energy going through the roof. That wasn't hard. And anyone who said there was going to be deflation 2 years ago, but you didn't know. I did not. It's a secular deflation. Is inherently deflation in our economy. But there's going to be short-term freaking battles with inflation, especially due to energy costs. But his view, the primary cause was a Fed-induced excess liquidity, is not universally held among economists. So he wanted, look how freaking silly these guys are, dude. He wanted massive fiscal stimulus, government spending, for programs to increase household spending. So we did that, but they weren't big enough. So now we have huge, massive fiscal stimulus, and that's what's causing the inflation right now. Fed excess liquidity is what's causing the inflation. Well, the alternate, equally compelling view is that inflation resulted from supply chain issues, followed by surging consumer demand as the pandemic wore off. No, again, it's all on energy. I don't know why none of these people can recognize energy. The high price of energy leads to high price of goods. It's just that simple. The shortage of goods and the surge in consumer demand drove prices higher. Inflation will remain in the 5% range this summer. The U.S. went from 2 to 5% of inflation last year, and the rest was just noise, like temporary spikes in gas prices. Okay, so we're not using gasoline anymore to gauge long-term inflation, like I talked about in my book. It's going to be difficult to get to 2% inflation unless the economy slows down and the imbalance in the labor market readjusts. Yeah. Summers expects the Fed to raise rates by 25 basis points at his next meeting. He predicted that the Fed will signal as agnostic about future rate hikes. He said the Fed is not highly credible because it got behind the curve fighting inflation. It may need to do more to establish credibility. The Fed's problem is analogous to adjusting the temperature in the shower in an old hotel. There's a 20-second lag. All right, whatever. He said it won't be a hard landing like 1982 or 2008 or 2020 wasn't a hard landing, Larry. The freaking guy. But even he's worried about Sniffy Joe losing support. He cautioned that when inflation comes down, historically, a significant economic downturn has followed. So Summers was not sanguine, whatever, about prospects for commercial real estate, whatever. Bet on the U.S. He says the prospects of the U.S. was better. I actually agree with that. Europe is a museum, Japan's a nursing home, China's a jail, and Bitcoin is an experiment. Yeah, I agree with that. Investors must put their money somewhere, and the dollar's a pretty good place. I completely agree with that. The U.S. has problems, but overall, you have to be impressed by its record and prepared to think about the broader historical lesson. Yep. I don't have any qualm with that at all. I 100% agree. I actually put a comment on here, which I just read to you from that book right there. Anyway, I don't have any qualm with that at all. I don't know why I'd be shorting equities, though. Shorting equities means you're borrowing to sell them at a future date that's lower. I forgot how it works. You're borrowing today to sell at a future date at lower, and you net the profits. That's the difference. I wouldn't be doing that. I've never done that. It's stupid. But I think there's something to be said. I don't think the markets are something's going to go. Something's going to give, either stocks or the bonds. I'm betting on the stocks before the bonds, and I could be wrong. And if I'm wrong, that sucks, dude. But be it as it may, you're still getting 4.5% on money market, and you're still getting. I get them. I got my Federal Home Loan bonds paying 6% right now, dude. I'll take that. Hey, I love your thoughts. Don't forget to subscribe to Doobie Duke, and don't forget to buy my new book. It's out there right now. We'll see you.